Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Ventus' stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 29 billion market cap. They're trading at $67 a share, and they have 437 million shares outstanding. Ventus is a REIT. It has 1,350 properties in North America and the UK. It owns 800 senior housing communities. It also has outpatient medical buildings and research centers. It was founded in 1983, headquartered in Chicago, Illinois. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow pretty steady, between $500 and $700 million a year. Margins look decent, between 11% and 16%. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's pretty low each year. Some years it's negative because they have lots of write-downs, lots of depreciation. Revenue is the sales for the company, and that goes up from 3.8 billion to 4.9 billion. Not a big growth, but it is going up each year, so that's good. They pay a 3% dividend yield, but they can't afford the dividend. It cost them $841 million. The way you calculate that, it's a dividend yield times the market cap, and they generate $726 million of free cash flow. So they're short. They can only cover 90% of their dividend. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows. Past year 4, that's $20 billion. We discounted those numbers back to today using the weighted average cost of capital. We got a value of the company of $18 billion. We divide that by 437 million shares. And we get a calculated stock price of $40. They're trading at $66, so they're trading at a 65% premium. It's a sell according to the model. There are 17 companies in the same industry as Ventus, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx. It looks like they buy the most properties because their main CapEx is the real estate. A debt to equity ratio of 1.3. That means for every dollar of equity, $1.30 of debt. Their dividend is 2.9%, which is lower than the median average, higher than Welltower. They generate a lot of free cash of $726 million. They rank second in market cap, far behind Welltower. All their price multiples are worse than the median, so they do seem overvalued. They generate $4.9 billion of revenue, second highest on this list. And their 5-year annual revenue growth rate is equal to the median of 5%. Health Peak is the highest at 17%. They're trading right at their 52-week high. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $13,500 today, a 3% annual return, a 35% total return. To summarize, I have them trading on a 65% premium, ranking 4 out of 10. They seem a little overvalued. Would I buy it short term? 4 out of 10. Long term? 6 out of 10. Ratios are a bit weak, so 2 out of 10. Financials are decent. Free cash flow up 22% since 2021. Revenue up 29%, so I give it 6 out of 10. Let's take a look at their income statement. They just released their 10K. Here's their numbers for 2022, 2023, and 2024. Revenue is going up a little bit. A pretty good growth from 2022, 1.4 billion, to 2023, 1.5 billion. It's pretty much flat from 2023 to 2024. Their triple net lease properties went from 619 to 622 million. Outpatient medical and research portfolio, 867 million to 875 million. A triple net lease is when the tenant agrees to pay TIM. That's how I think about it. TIM, taxes, insurance, maintenance. When I Googled it, it says taxes, real estate taxes, building insurance, maintenance, rent, and utilities. So pretty much the same thing. If your rent is $5,000 a month, the landlord may say it's $4,000 for base rent, $1,000 for triple net. But if your landlord did not do triple net leases, they would just say it's $5,000 for rent, for base rent. So it's the same thing in the end usually, but a lot of landlords like to separate out the taxes, insurance, and maintenance. There is a reason, and if you want more color on that, we could talk about it in the comments, or I could do a live stream. Oh, look at this. What are the disadvantages of a triple net lease? The main disadvantage of a triple net lease is the higher monthly costs as opposed to double or single net lease structures. Furthermore, Since tenants become responsible for taxes, this puts them on the hook for any tax-related liabilities, such as fines and penalties. That is true, but pretty much all expenses are passed on to the tenant, whether you do a triple net lease or not. Is there a benefit to triple net? There is currently no evidence of any health benefits to No Nut November. Okay, they're talking about a different triple net. Can you negotiate a triple net lease? If the actual dollar amount of the triple net lease isn't negotiable, you can attempt to negotiate what it covers. Your business may not need weekly trash removal or other maintenance services within the unit. Okay, let's go back to the income statement. Let's see if they give a different breakdown of the revenue. Here we go. Of the $1.5 billion, $875 million is OM&R, $622 million triple net. OM&R is the cost directly related to the operation, maintenance, and replacement of the treatment plant, collection system, and conveyance of wastewater. Okay, that's something different. Let's search it on the income statement. They do give a breakdown of shop, OM&R, and triple net. It's down here. Shop is food, utilities, taxes, insurance, repairs and maintenance, marketing, supplies, and other expenses. OM&R, utilities, taxes, insurance, repairs and maintenance, cleaning, roads. Triple net is real estate, taxes, and insurance. I never heard this term before. I guess it's used for this company. It's their own internal thing. Their shop revenue is $2.6 billion. So their total revenue is actually $4.9 billion. I was just looking up here at the 1.5. So it has gone up nicely each year from 4.1 to 4.5 to 4.9. A bulk of their revenue is resident fees and services, $3.4 billion, which is up a lot from last year. So the shop revenue includes sales of food. Here's a different breakdown of the revenue. Of the $4.9 billion of revenue, $4.4 billion is in the US, $500 million in Canada, $31 million in the UK. Below revenue are their expenses. Interest, the interest they pay in their debt, $600 million. Depreciation, $1.2 billion. Senior housing expenses, $2.5 billion. Outpatient medical and research portfolio, $300 million. So their total expenses, $2.8 billion. So these expenses add up to $2.8 billion. They have other expenses like G&A, and their total expenses, $4.9 billion, which is almost identical to their revenue. They did have a gain on the sale of real estate, also an income tax benefit. So they have positive net income, positive $81 million. The last 2 years, they had negative net income. But don't worry, they're a REIT and they have a lot of depreciation. Depreciation is an expense that brings down your net income, but it doesn't affect cash flow. I'll show you in a statement of cash flow is what I mean. So even though they have a really small amount of profit, actually negative profit in 2 years, we'll go to their statement of cash flows and you'll see that they're cash flow positive. Here's a statement of cash flows. Operating cash flow smooths out their cash. You can see their cash flow is pretty consistent. It was $1.1 billion in 2022 and 2023. Now it's $1.3 billion. This is how they pay a dividend with cash. The income statement is accounting. That's not cash. In their investing section, they spent a lot on buying real estate, $1.9 billion. Last year, they didn't buy much real estate. The year before, $446 million. So in 2024, it looks like they were investing a lot into growing the business. And the way they get the funds, the $1.9 billion, partially from operating activities, also from financing activities. They added $1.9 billion of debt, which is almost identical to how much they spent on buying property. They also added almost $2 billion of common stock. This dilutes shareholders. They pay quite a bit in dividends, $740 million. On my Excel sheet, I had $841 million because I took their market cap times their yield. I use a 2.9% dividend yield for the entire year. Maybe they paid a lower or higher dividend in the first few quarters. That's why I'm a little off. So in their financing section, they had a cash inflow of $1.4 billion. Last year, a cash outflow of $540 million. Let's look at the stock on Simply Wall Street. Its last price, 67, $29 billion market cap, up 10% in the past week, up 52% in the past year. They started trading way back in 1990. This is stock split adjusted. It was $2.50. By 97, it got to over $40. It almost got below its IPO price in 2000. It looks like it hit $344. And then over the next 12 years, it ran all the way up to $80. That was its all-time high in 2013. And it kind of traded sideways over 7 years. Down, up, down, up, down, up. And then the COVID crash. By April 2020, it was below $30. It actually fell below $20. It did run up to 62 in 2022, but then it didn't do too much over the next 2+ years, down then up, back up to 60. And since mid-2024, it's pretty much been trading sideways in a pretty tight range. Looks like between 55 and 65. Simply Wall Street's valuation is 79. They say the stock is 15% undervalued. 19 analysts priced this stock at 72. They say it's slightly undervalued. They always pay a pretty healthy dividend. It was 4% in 2015. It was double digits in March 2020 because the stock price came down. And now it's around 4%. The forecast is 3.4% by 2027. Here's their quarterly dividend payment. It was between 70 and 80 cents from 2015 to 2020. They did cut it to 45 cents. It looks like it's been 45 cents since June 2020. Yeah, 45 cents every quarter. The CEO's salary is around $1 million. Total compensation $13 million. Tenure as CEO 26 years. A female CEO, Deb Cafaro. In the past year, there's been insider selling, no buying. 97% of the company is owned by institutions and 2% by the general public. The biggest shareholder is Vanguard at 16%, then BlackRock, JP Morgan 5%, Schwab 1.2%, Eaton Vance 0.5%. Their employee count is down. It was 479 in 2014. Now it's 486. Actually, it's up a little bit. And the ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.